Hey, good morning, everybody. Can you hear me loud and clear? Mic test, mic test. Can everybody hear me? We'll get started here in just a minute. Mic test one more time. Can everybody hear me? Testing 1, 2, 3. Can you hear me? Oh, 1 second here. Got a new setup here. I'm just kind of trying to get everything organized. Testing 1, 2, 3. Can you hear me? Oh, okay, good. Thank you, Elizabeth. Yeah, I've got kind of a new setup here I'm using today, so I wanted to make sure it was working. Let me just 1 second. Okay, sorry about that. Let's get started. Again, apologies for the delay. So, yeah, thank you so much for being here today on this holiday weekend, and let's get started. So, we're going to dive into some different option strategies to trade in any kind of market environment. So, it's kind of a lot of times it's so confusing when you get into uh, different option spreads and how to use the different option strategies. So the question really comes down a lot of times to, what option strategy should I use, in this kind of market condition or for this particular, trade as far as this trading cycle. So there's a lot of things that can go into, selecting the correct, option strategy or options spread to be trading. So this kind of a workshop today, I kind of wanted to go over and go through kind of a process that I use to help, that selection process. So we'll get started here shortly. A little background on myself. Been started my trading journey back in the mid 80s. I was fortunate enough at that time to get a job with an oil company called Trans World Oil. Coastal Corporation back in Houston. They actually at that time had a training program where they would, bring you in, and train you to trade either crude oil or different oil products. So really fantastic experience and very blessed to, have that opportunity. And started me out in the refinery they had down in Corpus, Texas for about 3 months. It was great because you kind of learned the whole foundation of how it all works with the crude coming into the refining units and processing, jet fuel and gasoline and fuel oil, things like that. So a really great start. And then, spent about 5 years there with Coastal, two years out in Singapore. It was a really great experience out there trading, oil products and different Asian crudes. And then was hired by a company called Trans World Oil. At that time, they were the largest oil trading company in the world. It was Transworld, Fibro, and Mark Rich. And so that was a really, really exciting time in my life. Spent about 17 years there at Transworld, 16 of those in Bermuda, which was the corporate headquarters, and ran the international trading desk for 10 years out of Bermuda. So, we were in all the different markets, all the energy markets, foreign exchange, all the different futures, commodity markets. So it was a really crazy fun time. And that's where I started trading options. I remember it so vividly. Back in 1987, we sold options on cargoes of crude oil. So it was a collecting premium, and it worked until it didn't work, but we learned a lot on the fly. So it was a great experience. And anyway, I just want to give a little background. And so now let's get started with today's workshop. So the following workshop today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. So feel free to ask questions. Now, like I said, I've got a little bit of different setup. So if I don't see your question, send it again. I kind of have to get used to this format. Anyway, so I wanted to point that out. So let's get started here. So to me, the secret to trading profits and really comes down to utilizing options. So, when we look at trading, trading is a business of probabilities, and to be a successful trader, controlling your risk is what really wins the game. So by, knowing and better understanding how to manage and control your risk, it's going to make a dramatic and positive difference in your trading performance. And one of the best ways to do this is through the use of options and option spreads in your trading. Now, when we're trading options, they have so many more advantages than just trading stocks outright, but they can be confusing and kind of at sometimes debilitating to traders or investors unless you know which option strategy to use and then when and how to use those strategies correctly. So a lot of it goes into what is the market environment we're trading, what is kind of the cycle, things like that, and we'll kind of go through that. So I call this that debilitating trading dysfunction, or kind of nicknamed it the option strategy confusion, OSC. So it's something that we can all suffer from at times, and I kind of want to go through some of the things that can help you through this confusion. So the option strategy guide we're going to cover here today kind of goes through a number of different steps to kind of make it kind of a step-by-step process. So step one is to understand, how do option prices work. So we want to be able to understand option pricing in order to understand how to utilize the different option spreads and look at the different risk rewards that you get from the different types of spreads that you can use. And this will really then help you to maximize your option trading profits. So when we're pricing an option, the kind of one of the most important factors or pricing components comes down to time, and the other really important component is volatility. So they have the big impact on the price of your option. Now, when we look at the price component or time value, it's basically the extrinsic value of your option. So it's the premium that a rational investor is going to be willing to pay over the current exercise value, or that intrinsic value, based on its potential to increase in value before it expires. Now, this change in value of your option is based on time decay, and we can measure that using the Greek called theta. So this is one thing that's great with options. We have these different theoretical Greeks that we can use to kind of give us theoretical pricing indications or inputs for how the value of the option is. Now, the time decay value is going to always work against buyers, but it's going to benefit the sellers. And why is that? Because option theta values are either going to be a positive or negative value. So when you're long a stock option, so let's say you're long a call or you're long a put, that's going to have a negative theta value. So it's going to basically be losing value as expiration draws near. So it's a decaying kind of component of that option. Now, all short stock options, the reverse of that, if you're short that call or short that put, they're going to have a positive theta value, and that's going to indicate that the position is actually gaining value as that expiration draws near. All right, so it's very important to understand that concept. Now, many options trading strategies also will sell out of the money options on top of buying at the money or in the money options. So this is done in order to offset that negative theta decay. And so this can result in a lower time decay part of your option trade, so it decays a lot slower. and also it's going to lower your capital. And you can even, make your theta decay go to a positive type decay, or where it's going into your favor. So, different spreads, such as a vertical bull called debit spread, is one that is kind of constructed based on selling that additional out of the money call against the long call that you're long. The other one is a vertical bear put spread. So that's, selling a put against the put that you're long. And so that kind of brings in additional premium plus offsets that theta decay. And then the butterfly spread really offsets the theta decay and gives you actually a positive theta, as well as the long condor spread. So these are some really different spreads, and we'll go through these and how they work here in a few minutes. Now, the other pricing component for the value of your option is your volatility price component. So that's the implied volatility, and it's expressed as a percentage of your stock price, indicating one standard deviation move over the duration of the option cycle or the option series you're using. So in theory, a stock should end up within a kind of one standard deviation range of its original price about 68.2% of the time during that option cycle's lifetime. Now, this again is only theoretical, but it's a theoretical probability, and it helps us to forecast a security's price range or a stock's price range, and what that should be. And that should be, part of your process that you use for selecting the highest probability trade setups. So these are steps that we always go through, and I always go through, and our members of the Power Cycle Trader will always go through the expected move kind of forecast of where the option theoretically could go. That's one of the key steps before you ever put the trade on. So that's a really important thing to understand. Now, when we look at the value of the option, then it comes down to these components. So it's going to come down to that time value times the implied volatility times the intrinsic value or the underlying security value. So that this will give you then the value of your option based on these different changes in the components of your option value. So here's a kind of a good example of how this kind of flows through. So every Thursday we have a new weekly option series that comes out on most, big stocks or ETFs, et cetera. So on Thursday, at that point in time, you're going to have that first day, you'll have 100% time value in that option price. All right, so then time value times the implied volatility times the underlying security value is going to give you your option premium or value. So in this example, we'll keep the underlying security value at 1, so you can just see how time and volatility affect the price of the option. So day 1, we have 100% time, and if I plugged in a number of like 300 for the implied volatility, and so that gives you a value or a premium of $300. Now, when you come in after the weekend, say on Monday, you can see your time component has been cut in half. So then, 50% of your time is gone, that's decayed. And even if the implied volatility in this example spiked up to 800, it barely pushed up the premium or value of the option. So your value of the option here in this example would be 400, and we started out at 300. So let's say you had the implied volatility was 200, then you can see that the value of your option would only be $100. So it's a very important thing, to understand how these components work to give you your value of your option. At the end of the day, what happens? These two components of price go to zero. All right, so they both go to zero. And so that's what we want to be able to be aware of if you're buying options, or take advantage of these two components if you're selling options, and understand how they work and put those things into your favor. So that's a kind of a quick overview there. And let me just double check here. Yeah, it looks good. All right, so that's the first thing, you understanding how the value of your option works. Now, step 2 is trading time. So in options, we can actually trade time by selling time to take advantage of that option time decay or theta. So when we're selling options, we are, in essence, we are selling time and volatility. And so it's a really good example to think of an option as like a coupon that you get at a store, and you'll look at that coupon, it says you must use this by such and such date or else it expires. Well, that's exactly like an option series, right? So an option is kind of like a coupon that you get, and it's going to be valid for a certain amount of time, and then that's it, then it's gone. So take advantage of it. So when we look at the time component And kind of the graph of what time does with an option, you can see when we go way out in time, let's say we start 120 to 90 days out, there's going to be very little time decay starting out. But as we get about 30 days out to expiration or day zero, you can see then it really starts to accelerate. And now we've got these weekly options, we've got daily options. So there's a lot of different ways that you can play this accelerated time decay, either by selling it or, to understand and buy cheap options because the time decay is going down. So you can see that acceleration and how that works. And at the end of the day, what happens? Your time goes to zero. It's worthless. Your options are worthless. So you need to be able to be aware and adjust, when these things start to go against you. And that's what we can do with options. That's the really cool thing. We can make all kinds of really cool adjustments and things like that to adjust risk, adjust profits, things like that. Now, step three is trading the probabilities. This is kind of what I call the market maker's secret. It's what they don't want you to understand because it's how they make their money. All right, so it's based on, volatility, and it's based on time decay, things like that. So when we look at the option markets use mathematical market probability statistics for pricing out the movement of your option to its expiration. And the option platform basically that most all option platforms are based off of is what we call the Black-Scholes model. Okay, some of the different platforms have a little bit different input, but that's the key to these different option platforms or models is the Black-Scholes models, just to kind of point that out. Now, by knowing the probability of your underlying security or stock finishing within a certain range at expiration, this becomes key to then determining that what options you want to buy or sell and what option strategy then to use. Now, these statistics forecast in how likely it is that an option will fall within a certain option series price range up or down by its expiration. And the forecast then is what we refer to as the implied move of this stock. You might hear it called the implied expected move. Now, the implied move is then an estimation of that plus or minus one standard deviation move of your underlying security by its expiration. So this is a kind of a distribution curve. You can see a bell curve, so it kind of points out how the price distribution works. So we'll go through this example. So if you were to sell, let's say, an out of the money option, one standard deviation out, you're basically theoretically starting out with an 84% theoretical chance of that being a winning trade. Okay, so if you were to sell this price point here, one standard deviation in this graph here, it's right there. So this is the at the money. This is kind of normal distribution bell curve. And right here is one standard deviation range between that bell curve. So the 520 strike on the upside, so the call right here, or one standard deviation down would be 480 here. So that's the one standard deviation price point. Now, this price point then basically has a 16 delta. So I usually look at it like a 16 or 20 delta, but it's basically like right at a 16 delta, plus 16 for the call option and a minus 16 for the put option. Now, if you were to sell that strike, let's say that 520 strike, and it has that 16 delta being that one standard deviation price point, then an option delta of 1 is equivalent to 100 shares. So we'll say the option delta of 1 equals 100. So if you sold a 16 delta short strike right here, that 520 strike, then that kind of reciprocal of that is 84. So that's kind of how you can think of it. And then that tells you theoretically you've got an 84% probability that price will close at expiration below 520 if you were to sell that 520 call strike, or if you sold a 480 put strike, there's an 84% probability that price will be above 480. So this is how you can then play the probabilities really quick and kind of understand. Now, if you were to go out 2 standard deviations, basically right there, then you can see that's a 95% theoretical probability of that being a winning trade. So this is how it works, and that's why credit spreads, when you're have what we call a negative risk ratio, because you're starting out, if you sell purely credit spreads options, you're starting out theoretically with a higher chance of that being a winning trade based on these kind of probabilities. All right, so Important to understand this, and but again, it's theoretical, but that's the way the math works. So you want to be able to, kind of understand how the option pricing, all this stuff works to kind of put into your favor. So this is a thinkorswim option platform, and so here's like a reference to the option delta and probabilities. So if you look here, this is like Apple trading at $190. And if we look at this example, the 5 July series here, it has 28 days right there, says till expiration. Now, if we look here down to the at the money strike, right there at the 190 strike, you can see that it has the option delta, it says 52, so 0.52 or 52. So the way that you can look at that is that if you were to buy or sell that 190 strike, there's a 50% or 52% probability that price will be at 190 or below at expiration, or 190 or above, all right? So it's kind of like flipping a coin. So pretty decent probability. Flip a coin, blah, blah, blah. Now, if you look here, this is part of the option platform. It says probability. That's actually saying probability out of the money. So you can see that the combination, here you go, it's almost 100, right? So your delta is 52. Your probability out of the money is 50. So that's, so that would be like that 100 delta, right? So that's how you can look at it. Now, if we were to go way out of the money, let's say we go to this 215 strike right here, then you look over to the delta and it says a 0.05. So that's like a 5 delta. So a couple ways then to look at that, though. Look at the probability here out of the money. It says 95. So here you go. You've got that delta of 1 or 100. Remember, one option contract's equivalent to 100 shares. So that's a delta of 1 or 100. And you sold that 5 delta. So there you have that 95% probability, 95% probability out of the money. All right. So there's then on this, if you're just quickly assessing this 215 strike, if you were to sell that strike, then you can look here on your option platform and say, okay, I've got a 95% probability that price will be below that at expiration. Or the other way you could look at it is there's only a 5% chance that price will be at 215 or higher at expiration. So this is the ways that you can quickly assess, probabilities of strikes. Do you want to buy that? Do you want to sell that? So you can see here, if you sold or if you bought that 215 strike, there's only a 5% theoretical chance that that option will be there. And so that's why these options are so cheap, because if you are right, you're going to have a huge payoff. So the risk reward is in your favor if you get there. If it doesn't, that's what you lose. So that's kind of the way that you can kind of quickly assess, risk and probabilities using options. Now, step 4 then comes down to selecting the perfect option strategy, and it comes down to a number of different things go into what would be the perfect option strategy. So let's take a look. And before we get into that, though, I'm going to be doing an in-depth course on this kind of selection process starting next Saturday. So surviving the market turbulence, and this is going to be the option strategy playbook for fast breaks and sharp reversals. So this is a really fantastic course that I'll be doing in depth about kind of what we're going to cover today, but more in detailed, in depth for everybody that attends. So if you want to join up for this today, you're going to get a 15% discount off the course price that will be next weekend. So let me give you that link real quick, and we'll start there, and I'll kind of go through everything briefly, and then we'll get more into it at the end of this workshop for any questions or details about it. But everybody here put in, let me give you the special link. It's powercycletrading.com / you can see it at the top there, / guide special. All right, so here's the link. I'm going to put it in this box here. Okay, so there's your link. You should be able to click on it or copy it and paste it. Now, once you click on that link, it's going to pull up a payment drop-down form. Let me pull that up and I'll show you what that looks like, and then put in small cap guide GUIDE 15. Okay, so put this in, and then you can get that promotional code of 15% discount. All right, so let me get that link, the payment link up here, so you can see what that looks like. And Hold on. Here we go. So this will then, if you click on that guide special right there where my pointer is, this will pull up. Now this will start next Saturday, April 11th at 11 a.m. Eastern till 2 p.m. or however long we need it. Everything will be live, but also everything will be recorded if you miss parts of it or can't make it. And then we'll do a follow-up second part of the course on that Monday the 13th, and we'll have a dedicated Q&A the next day. So the Monday will start at 4 p.m. Eastern. So I've got a number of different kind of price points. Let me just kind of highlight those first. If you look here, hold on a second. I've got a question if I can find again. Here we go. Again, if I miss your question, apologies. I've got a like I said, a little different platform here. Okay. All right, looks good. All right, I think everything's good. All right, so then we'll start package one. I've got two different options. So course package one will be just the basic course, option one. This is going to be, the price is $197 when I go out to my list and everything. But for today, if you put in that special promo code guide 15, it'll be $167. Now this will give you the access to the live course and the recording of the course, any handouts that are given, and some extras that I'll show you here in a little bit. So a nice 89% course package discount, at $167. Great price for what you're going to get here. This is, as you'll see here later, this course is one of my most popular courses that I do during the year. Now then you can see package one, though, option two is with all the different bonuses, just for an extra $30. It's going to be $197. You're going to get all the bonuses and the indicators that I'm going to give for this course to be used with this course. So this is the course package two, course package one, option two, just for an extra $30, $197. So 93% off there. Now, if you want my course package two, this will include my alert service. Okay. So I've got 5 different type of alerts that I send out. This will include that along with your, everything in course package one. So you'll get, in course package two, option one, you'll get the live and recorded course and the extras, plus 4 months to all my alerts that I send out, 5 different types that I send out, plus 4 months to my trading club. So this will be, $597, but if you do it today, it's going to be $507. Okay. And there's a 2-pay for you if you like that as well. Now the other next one would be option package two. This is the alert package, but option two then gives you, like here, gives you all the live and recorded course, the indicators, and all the bonuses. And so just for an extra $30, coming in at $537, you'll get all that. All right, so wanted to show you that, highlight it, and then if you want to pull this up, click on that link and it will pop this up, surviving market turbulence. So pull this up and then you can see for your extra 15% off, use that guide 15. So then this will show you basically what you're going to get, kind of highlights everything. So I'll go through this kind of quickly and then we'll come back to it. So option one under course package one gives you the full course live and recorded. So all the materials. You're going to also, as an extra, get a 30-day trial membership to my trading club, which has a lot of nice benefits for you, trading room, videos, things like that. Plus, you'll get the follow-up live and recorded Q&A, and my option trading tutorial. You'll get that as well. So for today, if you use that guide 15, it's $167 there. And so just click on down here. This is course package one, option one. Click buy right there. This will pull that link here. You'll see everything that you're going to get over here, and then come down. And if you want to add my indicators here, you can. These are my trading indicators that I'll be showing you today when I'm showing you different trade setups. And these are available for like Thinkorswim, TradeStation, Ninja, Trade, eSignal, TradingView. So then put your guide GUIDE 15 small cap, right? Click apply, 167. If you do want to add the indicators, add indicators to the cart, go, and there you go. And then you've got course package 1 option 2 down here, which gives you all the bonuses and the 2 indicators. We're going to be using this in the course, my cycle reversal indicator and my extreme range band indicator. So you get these 2 indicators with this course package option 2, course package 1, and then all the bonuses. So you're going to get my kind of intermediate option course, Make Money with Options. You'll get that. These are prices on my website. And then you're going to get my Fibonacci price target mapping course. This is what we use in the course to kind of map out profit targets up or down. So you'll get that as a bonus in package option 2 here. You'll get the follow-up Q&A. You'll also get that 30-day trial membership. You'll get my option trading tutorial and my option strategy guide, 15 option strategies. You'll get that as an additional bonus. So that's all comes out to a total of over 1,300, and adding the course here at 1,600. That's what you'll get. So this is just going to be basically that, 167 plus the $30. And so for today it's 197. So just click on that. Come down here, you'll see everything that's going to be listed that you'll receive. If you have any questions, let us know. We can also, you can get my support people. So just put this here, GUI, if I can spell this right, DE15. Make sure it's small cap. The indicators, if you want them, click apply, and then there you go. Now, one thing to also point out, there's been a little confusion here sometimes. If you want to use just a credit card, just look up here, pay with credit card, or if you want to use PayPal. Okay, so just be aware of that. You've got those 2 links. So sometimes it might be a little confusing. All right, so that's course package 1, the 2 different options. And then if you want my alert service added to it, this is my open and close trade alert service. If you want more, help and guidance in your trading, then this is a great package for you to look at. And I've had so many members that have done this package, and they've learned to trade options as they go. So just to give you a quick overview of the performance that the alerts have had, they've been really good. Year to date so far this year through Friday, we've had an 83% win break-even rate. Okay, so we've had 36 trades closed out, 25 winners, 5 break-even, 6 losers. So for this crazy schizophrenic market, I would say that's pretty good. I'm pretty proud of that. Now, we've also had very, very consistent. Now, these are unaudited. These are just a summary returns. Now, we've been very, very consistent with the alerts as well. So for 2015 or 2025, excuse me, we've had a 79% for the full year win break-even rate, 151 trades closed out, 101 winners, 19 break-even, 31 losers. So, try to get as many winners. I kind of strive for that high winning break-even rate. And then since inception, I started the first part of the alerts. We've got 5 different alerts I send out, but this is based on the 4 different types basically. But from when I started the first alert in 2018 through Friday, we're still running about a 79% win break-even rate. So really good, consistent performance, month on month. All right, so just kind of point that out. Now, so what you'll get if you do this package 2, you'll get 4 months to my alert service. There's 5 different alerts that I could be sending out. Plus, you get the trading club as well if you do course package 2, and then you've got kind of options 1 or 2. So if you want just the straight course with the alerts, it's option 1. If you want the course and all the bonuses plus the alerts, that's option 2. So you can see here the different things that you'll get. 8 to 12 stocks or ETFs a month. Now we do a lot of different types of trades, butterflies or long condors, and this is what we'll go through here today. These different types of strategies. And then we do a lot of counter diagonals. We do what we call monthly penning trades. These are typically going to be butterflies, sometimes calendars, selective earnings trades during the earnings season, and selective kind of breakout reversals, which are sometimes credit spreads. So there are kind of 5 different trade alerts I can send out based on the, kind of market, the cycles, things like that. So that's the alert service part. And when I send it out, a lot of members just do their own thing, but I will always send out an option strategy to use if you want it. And so then I do a trade setup video review that day after the close to kind of give it more explanation why it was done. You get the trading club for the next 4 months. Now you can stop and start this service on your own. So if you go on vacation, you need you don't want to waste your time, you can do that. So there's no problem. And so you get my weekly Q&A live and recorded every week for the next 4 months, my video newsletter every day after the close for the next 4 months, access to my virtual trading room every day during the week, actually Wednesday through Friday for the next 4 months, and 50% discounts on anything on my website. So that's kind of a real quick look at that. We'll go through more detail here at the end of the workshop. If you have any questions, we'll be happy to ask those. So that's kind of a summary there. All you're going to get, and then you get access to my trading club for the next 4 months, and this gives you access to the trading room during the week, the Q&A during the week, daily aftermarket videos every day after the close, videos that are archived in our archive Traders Educational Vault, 50% discount. So use this today. So if you want the alerts with course package option 1, which gives you just the course and those extras, come down here, and that's option 1. Click on that, and then just put in the same link. You'll see everything listed over here on the left as to what you're going to get, and just put here guide, GUIDE 15, and there's a to pay down here if you'd like. You can see down below. Plus, if you want the indicators, you can add that, and so it'll be 507. Pay with credit card or PayPal, and then if you want the indicators and all the bonuses plus the alert, that's package 2, option 2. Click on that, and then the same thing. Just put in that guide, GUIDE 15. All right, so that will drop your price down to $537. All right, so we wanted to go through that, and let's kind of move on. Please feel free to ask any questions if you need more information on this, and we can address that more towards the end of the workshop today. And again, just to point out one more time, so there's no confusion, if you do want to use credit card, it's at the top up here on that payment link. It says pay with credit card, or down here is PayPal. All right. And then also, if you are a member, or if you bought other courses from me in the past, and you're wondering if you ever took this course, you can just go to your members area, and you'll see within your members area where you have all your courses listed. If you see option mastery, that'll say, okay, that's the name of this course that I'll be doing this next Saturday. So I'll do this maybe once every 6 months, maybe once a year, just to let you know on that. So the next part of the kind of the process of selecting the right option strategy for the market that you're trading is what I call kind of the process progression that you want to look at. So first off is, what is going on with the market? You want to identify the market cycle. So, do you think the market is going, up, down, sideways, or no idea? So now, I mean, obviously, there are a lot of different ways that we'll do what is the market cycle, and this is what we'll cover in the course. I've got a very kind of mechanical, way to define cycle. Okay, so that's going to be part of the process in the course. I'll show you exactly what I use, but based on what I use, we are right now, we're in a downtrend, right? Now, the next thing is you want to identify kind of the chart pattern, and this has really helped the alerts, because we've had such a high percentage of winning trades, and a lot of it comes down to selecting the right option strategy to go with the chart pattern that you're trading. Okay. And so I'll also point this out and go through this in great detail in the course. So there are 5 specific kind of chart patterns that I look for, and then I'll assign different option strategies based on that chart pattern. Now, the third thing is what we call the time horizon, all right, or your duration of your trade that you're going to do with the option. So when are you expecting that trade to make money? So are you looking for this to be today, like a day trade, tomorrow, or swing trade, or long term? So that's going to be very important as to then what option strategy to use. Is it going to be a short-term trade, or are you looking for a longer-term trade? So there are different strategies to match with your trade duration that you're looking for. The next thing, and one of the most important, is your capital at risk. So based on the market conditions, there's always going to be uncertainty in any kind of market that we're trading. but we want to kind of quantify, define that uncertainty. Are we in a low risk kind of a uncertainty market, or medium or high? Well, right now, we're more an extreme uncertain kind of market. So based on the risk conditions in the market, then that'll also dictate what are the best option strategies to use to control risk, to really tighten it up. So these are things that go in, steps into selecting the best option or option strategy to use based on these kind of components. And then the next is your objective. Are you looking more for passive income, profits, hedging, capital gains type setups, portfolio hedges? So that's a really big part of the selection process as well. So this is what we'll go through, kind of a detailed, more assessment of this in the course starting next Saturday. And then I have what I call my go-to option strategies. So these option strategies are going to be used based on, the market cycle that we're in, and then the market conditions being traded. So the different ones that I typically will go to will be, okay, we could just go long calls or long puts, or maybe the market telling us, let's tighten it up. Let's go with the vertical debit spread. Maybe we should use a vertical credit spread, or maybe we should really get tight and use a butterfly, or a long condor, or a calendar diagonal, or maybe certain situation we may want to use a synthetic long and start selling calls on it to amortize it down. So these are some of my, what I call my go-to option strategies. There are a number of other types of strategies, but these are just kind of the bread and butter. Okay, these are the ones that you really need to know in order to trade the different conditions and cycles and things like that. All right, so these are the ones that we'll kind of touch on. Now, the first one, are long calls or puts. So these can be used, for your day trades, your swing trades, trades that are, maybe last 1 to 10 days, or they could even be longer term. Now, these are generally going to be, when you're buying a calls or puts, you're typically going to be buying your delta of a 50 or a delta of 70 more in the money. All right, so there are a number of different reasons for that, but that's kind of typically what you look at, a 50 to 70 delta. So these are going to be defined risk, because your risk is going to be the cost of either your call for an upside move or the cost of your put for the downside move. So it's a defined risk with unlimited profit potential upside. So if you're really right on the money and you're on direction, this is where it pays off. But remember, these are going to be the highest as far as time decay as well. So that's a really important consideration. Now, the kind of the next step would be, your progression would be up to a vertical debit spread. All right, these can be used for your swing trades, longer term trades. They can also be used in such situations for day trades. So the vertical debit spread is defined risk, low capital cost trade, and lowers your time decay because you have that additional option sold against it to bring in some positive data. So you've got your profit capped, and you've got your losses capped on this kind of trade. So it's a defined risk kind of trade setup, and it's a really great spread to understand and use in certain situations as well. Now, the next one is your vertical credit spread. So this is what I call the probability trade. So this can be used as well for your day trades, your swing trades. Best used when implied volatility is higher to get you more premium. And again, these are spreads, so it'll be a defined risk. And this is what really takes advantage of the time decay component of your options, as well as implied volatility. So these are best used if you're kind of in a sideways price action where you've got a kind of capped upside or downside. You can use credit spreads in certain situations. All right, so that's the vertical credit spread. Now, the vertical call debit spread, let's go through how this works so you can kind of get an idea of the construction and what it does. So in this example, this is going to be a debit spread where your risk is your debit paid. So you can see here, this is the risk profile, all right? And so you can see here's so here's your zero line. So you can see below zero, you've got this negative 300. So that's going to be your risk of the debit spread. So in this example, if you went out and you see the profile, you bought this call here. Let's say you bought a call right here, and that call strike is 10-10, all right? And so then, you're going to have that 10-10 long call. But if you want to tighten the risk, reduce the risk, and also reduce data, then in this example, we could sell a call above it, out of the money above it, at 10.20 in this example. So you can see that 10.20 would be your short strike. Now, you can see the spread then is $10. 10.20 minus 10.10, that's $10. That's called your spread width. So $10, remember, one option contract is equivalent to 100 shares. So a $10 wide spread times 100, the cost of this spread, the spread here would be $1,000, a $1,000 wide spread. All right, so your cost of the trade then is called debit spread. This $1,000 wide is $300, right? Debit cost. So that's buying the call here. Let's say maybe you bought that call for 500 and then you sold that call here for 200. So your net cost is 300. So your potential profit then is the difference. So in this trade here, if it was at expiration at 10.20 or higher, you're going to make $700. Now your upside profit's capped right there at that 10.20, but you're 700. So if it keeps going up, no more profit than 700, but still not a bad return. So in this example, this is what you have, a 233% potential return. So you could look at it and say, okay, I'm risking $1 to potentially make $2.33. So that's what we call positive risk ratio. So that's nice. That is not bad. All right, so that is a lot better than a credit spread. So here's your credit spread. So this is what we call a probability trade, because look at the difference here as far as your profit versus your risk. So here you would be selling, let's say you sell this call here, the 10.20 call short, okay? And then if you sold that short, you've got unlimited risk. So if the market keeps going up, you have unlimited risk on the upside. So to cap that upside risk, then you buy a call out of the money above it. So in this example, we're buying that 10.30 call. So you're short, this 10.20 call here, and you're long that call up here to cap that upside risk. But for doing this trade, you can see you're going to get a premium of $200. All right, so the spread width is the same. It's $10 wide or $1,000 wide, right? Now your credit received as your profit. That's your max profit, $200. But look at what happens here. So you've got a $1,000 wide spread. You bring in a credit of $200, which would be your profit at expiration if it closes below 10.20. But if it goes up, you have the potential. The difference is what your potential loss is, and that's $800. That would be the margin that you would have to put up for that trade. So if you look at this, this has that negative risk ratio. So you're risking $4 to make $1. So you're like, why in the heck would I ever do that? That's because it's probability. So let's say this 10.20 strike here that you sold, that call that you sold here, when you sold it, had a delta of 20, right? So then theoretically, if you have that delta of 20, remember the example I showed you earlier, the probability theoretically is there's a theoretical 80% probability that price would be below 10.20 at expiration. So that's why the risk ratio is different. You're starting out theoretically with a higher chance of this being a winning trade. All right, so that's a negative risk ratio. Now, my favorite thing is to mix and match these together to offset and to add additional and give you positive theta, and also to reduce capital at risk. So that's where you can do things like a butterfly spread, very unique strategy that combines buying options plus selling option spreads together. So you're going to be, having a vertical debit spread combined with a vertical credit spread. So you get the best of both in this kind of situation. It's a defined risk trade, takes a really big advantage of time decay, implied volatility collapse. And this is going to always give you a positive theta, no time decay. This can be a great one to use for directional kind of swing trades, 1 to 2 weeks out. Typically, you don't want to go too much further out than 2 weeks. It's kind of sometimes what I call dead money, which we'll talk about. Now, when used correctly, this is going to give you, of all the different option spreads that are out there, the butterfly, if you get it to pin, which we'll talk about, will give you the highest return on your capital at risk of any option spread strategy. And these are also a great hedging strategy to add to your trading portfolio. So the butterfly basic construction looks like this. So let's say you're, a call butterfly. a long call butterfly. So you're long that 10-10 call that we looked at earlier. Then you're selling up here, you sold that 10-20 short strike here, right? So you would have a call debit spread basically right there. And then we had the other part of the trade. I showed you the call credit spread, selling a call here at that same short strike 10-20, and then buying that 10-30 here to cap that upside risk. So when you look at this one, what do you have? You have that debit spread. You had a debit cost of 300. You had the credit spread. You brought in 200. So look what happened. So still a $10 wide spread on each side. This is what we call a balanced butterfly, but my risk then is reduced to $100. Okay, so the maximum risk now, if this thing ripped up to the upside or to the downside, your risk is going to be capped at $100 debit cost. Okay, now the beauty of this though is that if you were to get what we call a pin, where it goes out at that 10-20 strike at expiration and it pins there, that's where you make your max profit, all right, which would be $900, okay? $10 wide spread or $1,000 wide. Your cost of the trade, you've reduced it to 100 by doing this. So if you did get a pin right there, you made $900 on that risk of 100. That's a 900% return, right? We'll take that all day long. But even if you go out in here, you still have a great return, but look at your risk, super low, right? So this is a really great return. And in this situation, you're risking $1 to make $9, right? So really good positive risk ratio on the butterfly. Now the butterfly though, you got to thread that needle. So there are, reasons not to use a butterfly, but to use something else. So that's a really cool spread. Now, the other one, I call it kind of the offshoot or cousin of the butterfly. It's what we call the long condor. And let me make sure everything's going right here. Okay, sorry about that. So the other spread is the long condor. So very similar to the butterfly, but because it's combining buying and selling option spreads together. So it's going to be long a vertical debit spread with a vertical credit spread. Now with these strategies, you can do these with calls or puts, right? So we're looking for upside market, we're typically going to use calls. If we're looking for a downside move, we're going to be typically using puts. So the long condor though, what it does for you, instead of having that really tight needle or thread that you have to thread to get that max profit, the condor is going to widen out your profit zone. So it looks like the risk profile looks kind of like that. So it moves the credit spread short strike further out. So instead of having that credit spread right there, it's going to move that credit spread further out, giving you that wider, bigger profit zone. But again, it's going to give you positive data, no time decay. And these are also great for swing trades, 1 to 2 weeks out, great return on capital, fantastic for hedging. All right, so this is kind of the first drop-down progression that we'll typically use to hedge something, is hedge it and adjust it to a condor. And so this is what the profile looks like on the condor, So you could be long calls, you could do a call condor, or you could do a put condor, the other you could do with, long put, short put, long put. I mean, that's a great strategy. And also these are great for certain market conditions and certain chart patterns that I like to follow. All right, so that's the long condor. Now the next one in the old trading portfolio that we use a whole lot of is the calendar diagonal spread. So again, this is a little bit different structure, but it's structured for more of like a medium to longer term directional option trade setup. And this is where you're, speculating on trend either up or down, and also good for a hedging kind of a spread setup. So basically what it is, it's basically a vertical diagonal debit spread where your long option leg of the spread is further out in time. So further expiration out. So further out in time versus the short component that you're short is going to be closer in. And so that is going to give you more accelerated time decay the closer in you are. So a really great strategy. So, you think of a debit spread, they're in the same option series, but when you do the calendar diagonal, your long is going to be further out time, so it's going to be a lower, slower theta decay, and the short part of the spread is going to be closer in to give you that accelerated theta decay. So fantastic structure for certain market conditions. We do a lot of these. So the trade construction then again takes advantage of that accelerated time decay characteristic from the short dated option that decays faster than the back long dated option. There's then that additional credit spread, vertical spread component. That is what gives you the big potential profit on the spread, and that's why it's called the diagonal. So basically, a lot of times you can do this spread, and this is kind of give you a situation where you're buying options at a discount. It's like a covered call, but instead of buying the shares, you're going to be long the options, making it much cheaper, great returns. And this is structured for a debit cost as well, and also will always have a positive theta. So of all the different strategies, we do the most of these, and then condors and butterflies. So the diagram, looks kind of like that. It's think of a vertical debit spread, but instead of having your vertical debit spread being all the same option series, the calendar diagonal, your long leg is going to be further out in time. So that, let's say expiration 3 or something, and your short leg is going to be close in time, expiration 1. So you get that accelerated theta decay, and then we can roll it. It's just a great strategy in the right situations. Okay, so we'll go through a couple examples. Now, the other one that I wanted to show you, and this is a really unique strategy too, again, for very selective, specific times or market kind of conditions. And this is what is called a synthetic long option strategy, which replicates the payoff of owning the underlying stock or asset. And this is done by combining different option contracts together to create a synthetic long structure. So this then allows you to gain exposure to price movements of your underlying security while requiring very little initial investment. Fantastic trade setup for longer term setups, all right? And then what we will do with this is we'll sell calls against it. So it's kind of replicates owning expensive shares, but we're going to do it with synthetic long options. We sell calls against it for a fraction of the cost. We can amortize it down. Just a really unique, cool strategy to use in certain situations. So again, here are the 5 kind of go-to strategies that I like to look at on the spreads. So vertical debit spreads, butterfly, long condor, calendars, and selective long synthetics with the protective put. So we're going to go through a couple examples here to show you the actual structures of these trades, and when they were used, and the kind of condition and the cycle there and chart pattern. Now next weekend though, this will be much more detailed on all these types of trades. All right. So again, first one, let's go and look at just a call debit spread. So here's an example on ConocoPhillips. So this was a long directional trade setup. A defined risk trade. So you could have been long just calls, but this was structured to have it defined risk. So we've got upside cap, we've got our risk cap, but we've got our profits capped as well. Great for swing trades and breakout reversal type trades. Trade duration maybe 1 to a month out. You could go further out. This is going to lower your theta. It's not going to give you positive theta, but it will lower your theta. The returns on the debit spreads are, kind of 1.5 to maybe up to 3, maybe sometimes 4, depending on your spread and how far out of the money you go. So here's a setup that was done. This was on Conoco. Okay, so we had a Conoco. The markets were trending up, and we had a kind of a sideways lull here. All right, so it had a really nice move up, really beautiful trend up, and then it churned sideways here. These are my indicators. I like to use the 4-hour and the daily, kind of a swing trade time frame. Okay, so you can see the 4-hour, we started getting a cycle reversal. So with the course next weekend, you'll get this indicator below here, the cycle reversal indicator. This comes with the course if you do package option 2. So we had a cycle reversal. That was the first thing that happened, and then we had my momentum cycle 1 and 2 going positive here. Okay, so this was where the trade was set up, getting in right about here at 119. It was breaking right there, these breaking that upside right there. Okay, so then you can see on the daily cycle reversal, cycle 1 and 2 going positive. So this was a breakout type trade setup. So this was done with a call debit spread. And so here's what it looked like. So here's the kind of the risk profile of the trade. So this was using the 20 March series. This was on the 12th of March. Conoco was trading about 119.05. So this went out using that 20 March series about 10 days out and bought the 120, 124 call debit spread. So it looks like that, right? Long the call, short the call here. The spread width was $4 wide, all right? So you take that $4 or 400, the cost of the trade was $1.25 debit cost, or that's 125 bucks. So if it closed at the top of that debit spread at 124, your profit then is 275 capped. Okay, it could keep going up, but you're capped there. That's a nice return. 2 to 1, 220 bucks. You risk $1 to make $2.20. All right, so you see your risk here is your debit page. Your potential is to make max profit of 275, and that's your kind of 2.2 to 1 risk reward ratio, positive ratio. And so here's what it looks like on the risk profile going out. So you're long that call here, that 120, and this was out of the money a little bit. This is what made the return better, and this is what you'll learn in the course. How to, construct it. Where should you go? What delta should you use to, create higher probability or trade or higher potential return trade versus probability type trade, and then short that 124 call here. All right. So trade here on the 20th was going out 126.86. This was up 250 bucks per spread. Okay, so we had the spread $1.25 or 125. Spread blew out to 375. So your profit is 250 per option spread or 200% return. So if you did one option spread, your risk 125 bucks, you made 250. Now, if you did 10, then you make 2,500. So these are all based on like a option per spread. So when you're looking at different trades, either future, whatever it might be, everything's compared on a per contract basis. So you can look at the different things and kind of compare things by one option contract. Okay, so but then just multiply it by however many you may want to trade. So that's what your called debit spread would look like, and then we could do is put debit spreads if we want for a downside. Now the next one we talked about was the butterfly. So here's your wide wing butterfly, and this is going to give you a wider profit zone. So we can widen the wings to give us either a big, huge zone area for profit, or if we want to really tighten it up, to tighten our risk, we can make it really narrow. Great for trading at higher volatility markets and higher volatility stocks, so we can reduce the risk so much. Structure, again, going to give you defined risk. It's going to be your debit pay. Great for hedging because we can leg in, leg out. We can add legs. So we can start out with a debit spread or credit spread, add the other side, and create the butterfly. Great for pinning trades where we think, okay, I think GLD might pin here at $200. Let's do a butterfly to capture that potentially for very low risk if we're wrong, but if we're right, we'll make a huge amount of money on that risk. Great for high volatility markets because implied volatility goes up. That increases the price of the option that you sell versus the butterfly, reducing the cost. Trade duration, 1 day to 2 weeks out. No time decay. Returns of 10 to 1, 2 to 1 or higher. I'll show you some returns here that we have done on butterflies where we had like a 21, okay? So a 2,000% return. These are definitely possible and actually more than that. So here's an example of one that we had on QQQ doing for a downside move. And this was a wide wing put butterfly, $10 wider, $1,000 wide spread. So this trade was set up for downside move, wanted to keep the risk low. And so it was trading right here on the trade QQQ 314.16, 14 right here. And it was breaking. Here was the trade setup, was breaking this area here. This was a moving average break of the 21 exponentials is what I a lot of times like to use for triggers. But we had our momentum negative cycle 1 and 2, cycle reversal right here, and then we were targeting a down area, which was kind of a Fibonacci and a moving average area down here at about 304, 305. So this was kind of what I call a targeted trade based on our chart analysis, moving averages. This would be based on our Fibonacci price target mapping analysis, which you're going to get as a bonus in the course. All right, so here was the trade setup targeting the 304, which was a target based on Fibonacci, moving averages, price action, things like that. So that was the target. It was trading when we set it up 314.60. So we targeted 304. So did the 314, 304 put debit spread side, then sold the 304, 294 bull put credit spread. So it created a wide wing put butterfly, which had our risk then defined to $2.10 or $210 was our maximum risk. Okay, the debit paid. Now, the potential profit, you take the spread width of $10 or 1,000 less the cost of the trade, the debit cost. So potential, if it went out at expiration at 304, we would make $790. So looking at that, not bad. That's a 376% return. So risking $1 to make potentially $3.76. Or if we're not going to get perfect, we still have a nice wide range, but we have a very nice potential return, positive risk ratio, plus we will always have a positive theta. So if the market just sits sideways all the way through, we're gaining from that theta. All right, so here's where this went out. Pretty nice. It went out at 306.17. Pretty nice outcome of the trade. So at that price at 306.17 wasn't perfect, but it was still a really nice profit. This was up 572 per butterfly contract. If you did one butterfly, you made 572 bucks. So the spread went from $2 debit cost where it was set up to 782. All right, so there's your profit. That's a 272% return. A lot better than if you'd sold short the QQQ, you would have made 3.6% per share gain. So taking advantage of time decay, that volatility collapse, which goes out to zero, low defined risk, high potential returns. So that's your butterfly, kind of a wider butterfly setup there. Now this is another one that from time to time we'll get what I call the lotto ticket, and this is where we look for penning trades. These are very selective, but these are a lot of fun, and these things can be really big payoff. Here's an example of what I call a penning trade or a lotto trade. This is one that we did, and these are some of these trades are alert trades that were sent out to alert members. This is one of those. We did this one, a butterfly pin for Tesla, and this was a spread that we did on the butterfly with $250 wide spread on the butterfly. But this thing was over, I think, 1,800%, 1,900% return. So this is kind of what it looks like when I send out alert. This is Telegram. This was sent out. This was on the Tesla trade. So this is like on the 8th of February, and this is what I call a long binary lotto type trade. So you're risking your debit paid. So you either win or you lose, binary. All right. So this trade, though, you'll see why it can be so cool. So Tesla was trading at 189.35, and we were looking for a pin based on different things that I look at 200. So did the 197.5, 200, 202.5 call butterfly, $2.50 wide spread, and I said do that at around $12. That's 12 cents or 12 bucks. So ended up with the spread, on for a total cost. I believe we did get it on for 12 bucks. And then you can see it real quick here on the 16th. Now it was trading at $200. And then going into the 16th, going in towards the end of the day, this was a perfect pin. And it was trading at $200 right here. This was up on our risk of 12 bucks. This was up 1,916% return. It was up 230 bucks on that risk of 12 bucks. So this is what we call a penning trade or lotto trade. And this is what you can do with butterflies. So here was the trade setup on the entry right here. On the 8th, we were looking for potential move to 200 at expiration, and it did pin there at the 200 strike. And so here's what the risk setup looked like. So long the 197 call, short the 200 call, short the 200 call, long the 202.5, $2.50 wide spread on both sides. Okay, so $250 wide, the cost of the trade, 12 bucks. Look at this, 12 cents. That's why it's a lotto. So if we went out the top of the tent right there, perfect pin, this would make $238 per butterfly on that risk of $12. That's a return of 1,983%, right? So these are definitely trades, possible returns. And this was to the penny. I mean, this was amazing. Now you're scaling out. You don't, wait for the, last second, but this is where it did go out pretty much at the last second. So at expiration, then this was a perfect pin at $200. So the max profit 238. It made 1,983% return over that 8-day period from that kind of pinning trade setup. So really, really, really cool trade setup for certain situations. Again, knowing when to use it is the key. And here's just another example. This is a long put condor, okay, using SPY. And so this was another alert trade setup. I won't go through the details here, but this was, adjusted. This was started out as a put debit spread, and then we adjusted, reduced the risk, and reduced our theta decay by adding a bull put credit spread, making this, or adding just a put, and made this into a put condor, okay? So this was a really cool trade. So it was trading right here at 568. So we originally started out with just a vertical put debit spread, 563, 560 at around 85 bucks. And then the next day we adjusted this to a put condor by selling a vertical bull put credit spread, the 550, 554, 547.5 bull put credit spread to it, reduce our risk and theta. And so now we had this put condor on. I'll show you how this turned out. And we had reduced our risk way down, but we had a really nice potential for a big profit. This ended up, going out making over 500% return, and we had super low risk on the trade. So the original trade was a put debit spread, so trading right here, breaking down hard, okay. And so initially set that up, and then when it broke hard down here the next day, we sold way out of the money bull put credit spread below, bringing in a lot of premium, reducing our put debit spread cost and reducing theta. So we ended up with this structure here, which is what I call, opportunist head trading management. So we started out with a nice put debit spread, 563, 560, $3 wide spread. All right, so put debit spread like this. And then when it crashed down, we took advantage of the sell-off and sold the 550, 547 bull put credit spread down below, bringing in a lot of credit to offset the debit cost. So we reduced our cost of this trade from the debit cost that we had originally down to 43 bucks, 43 cents, okay? So now we had a potential, if it goes out inside this profit zone here, the max profit would be 257 bucks, $3 wide spread, less our cost of the trade, now 43. So we could make 257 in here, and that would be a 597% return. So another really great structure for the right condition, and went out, right there. So this turned out perfect. So adjusted cost down to 43 bucks, blew out, and went out right there at 556 between our two spreads right here. So we had a profit here of $257, on that reduced risk of 43. So 597% return and a positive theta trade by offsetting the negative theta from the debit spread with that credit spread. Now here's, one of our my favorites, and then here's another one that we do a whole lot of these. This is one that we did just recently on Palo Alto. This was a long call calendar diagonal that we adjusted into a condor for super reduced risk, okay? So calendar, again, we went through that structure a little bit earlier, but it's a very defined risk trade structure. The debit cost is your risk paid or risk of the trade. You're basically in this structure, you are selling time and volatility, so it's kind of like a credit spread. You get that advantage. Great for directional targeted trades up or down. Great for collecting income, getting paid while you're waiting for the trend to kick in. If you're looking for an uptrend or downtrend, we can structure it either way. Trade duration on these can be 2 weeks up to years. Okay, great trading flexibility. Adjustments, we can do so many different things. Positive theta, no time decay. So it's kind of what I call my flexibility trade. So here's one that we did just recently. This was alert trade setup. This was back on the 4th of March. And this was what I call aggressive. There were a couple of conditions. This is based on a 4-hour time frame. But Palo Alto was trading, the software companies were getting crushed. So this was a really kind of more aggressive, but it was trading right here, 157.5 when we set the trade up. I'll put with the alerts, I'll put my targets in. So target 1 was 161, 167. So the original trade setup was doing this calendar diagonal where we went out to long the 13 March, short the 6 March, 157, 165, call calendar diagonal at around 380. And then on the 5th of March, we did let's see, we took some profit and it was currently up 296, hold a break even stop. And then on the 5th of March, we did an adjustment here. We did a profit adjustment here where we adjusted this into, I won't go through all the details here, but we adjusted this to a long call condor by doing a couple of things, sold to open. And anyway, it's a lot to explain here, but that tells the members how to do it, okay? And so then on the 13th, now this thing was up big on profit. So now it was trading from when we set it up 157.5. Now on the 13th, it was trading at 170.05. And we had adjusted this into a long call condor, the 13 March 160 call, short against it the 13 March 170. So that's your debit spread side. And then also had the 13 March 175, 180 call credit spread. So that created this call condor at a super low risk. And we actually were up over 1,200% return on this trade adjustment. So let's go through this trade here. So here was the setup where we originally got in here on the alert when I sent it out on the 4th, 157 right here. So it was a cycle reversal. You'll get this indicator. Momentum, cycle 1 and 2. Break, here's the price trigger was breaking right here. That 21 moving average went long. Initially, the call calendar diagonal. We did an adjustment on the 5th. Okay, so this was set up on the 4th. The 5th, we did an adjustment into the long call condor, and then we got out, on the 13th when it was trading at 169.88. So here was the trade setup and the adjustment. So the original trade, when we first had profit, typically what I'll do, I'll say, make sure you lock in some profit and then adjust balance. So on the 5th, the profit was traded at 163.03. So the original calendar diagonal 157.5, 165 that we set up at $3.80 now had blown out to 691. All right, so we had a profit here of then $300.11 per spread, 82% return just on the pure calendar diagonal. But then we did the adjustment, and what we did was we rolled up, we locked in a big profit on that 157.5 long call and rolled the long strike up to the 160 and then rolled that short strike to the 13 March 170. So this is, the adjustments that we can do with these types of trades. And we'll go through this in the course. So then ended up in that duration series, the 13th February with this 160, 170 call debit spread. Okay. We originally had the 157.5 call long. We adjusted up, locked in big profit on the 157.5. We took profit and sold the 170 there. So we had that call debit spread there. And then when it was up here, we sold against that, the 175, 185 call credit spread, completing this adjustment to a call condor that was $10 wide on both sides. So $10 wide, $1,000 wide spread. We adjusted our cost down to $65 right here for this 160, 170, 175, 185 call condor. So if it goes out anywhere inside the two spreads, potential profit $935 per one spread, right? 1,400% return if that happens. this trade went out right there. We got out of it a little bit earlier because we didn't want to risk having this thing move against us too far up or down, but still locked in a great profit. So it's trading right here on the 13th, trading at 169.88 right there. So still had a little time decay in there. So the spread at that point went from 65 bucks to 888. So we had a profit of 823 per spread, 1,266% return. All right, and a positive theta trade. So really cool trade. And then one more that I wanted to show you was the synthetic long trade. Now this trade is this was set up like 2 years ago, and it's still in play. Now this is a synthetic long spread on Google. So let me show you how this works. So this is a really great structure in certain situations in the market. So this is going to be long with a protective put, protecting the downside. So it's great for, smaller upfront costs, fraction of the cost of having to own the shares. Great for traders with limited capital. Allows investors to free up capital for other, investments. So, if you're doing, if you've got a trading portfolio and it says, hey, buy 800 or buy 200 or 1,000 shares of something, instead of having to go out and spend money on buying 1,000 shares, we could do this with 10 contracts, doing a synthetic. Built-in leverage, control larger positions with less capital. Great for trading medium to very long-term trends on securities. We can cover the downside protection with the put below it. Great for trading covered calls. Duration of these trades can be 2 weeks to 2 years or longer, as far out as we can go with the leaps. Great for a hedge trade, positive theta, no time decay. So this is one that was set up on Google back on the 15th of March 2024. So Google, this was pretty cool. Google is trading down here at $141.18. All right, look at this. I mean, okay, so this is what's so cool about these types, this trade in the right situation. Now, on Friday, Google went out at 295.77 right there. It had been up this high. All right. Now here is the synthetic. This is to show you the difference between if you had gone long the stock and bought a put below it. This is what we call a covered a long stock with a protective put. Okay. So here's the at that time on the 15th. If you did this trade where you're just long the shares, say you're long 100 shares, and you bought a put below it, the 110 put below it, that's part of the cost in the trade. At that time, on the 15th of March 2024, that cost was $148.80, the debit cost to do this 100 shares long, right here, 100 shares long with one put below it, the 110 put on the 18 June 2026, okay? So that was $148.80. All right, now on the 4th, well, today, just to show you based on the option analytics today, it was trading at 295.80 right here, okay? So then the covered stock value shares, then blue, were at that point today, were 296.89 right there, see that? All right, so less, when I set this up, if you did it just the covered put, it was $148.80. All right, so your difference is your profit per share, based on today's date. So that's $148.09 per share, or if you did 100 shares, to make it equivalent to one option contract, you're up $14,809. So not bad. So your return then on your capital at risk is you're up 99.5% return on capital. But here's the beauty of the synthetics. So here's if you did this with the synthetic long with the put below. All right, this is what we call the custom. And there are a number of different ways, but I'm just showing you the basic component here. So here it is, doing it with synthetic options long with that put for the downside. And, trade entry was on the 15th of 2024, 141.18. And then today, using the analytics to show you, Now, if you did this, this is being long the synthetic call with the put below it. So you're long this structure here, a synthetic option, where set that up. It was traded at 141.18. Did the synthetic with the price of 140 bucks plus the downside put bought against it, the 110 put. So the cost of this was $21.18 per option contract. Okay, so look at what this one was valued at today. So today, this trade was based on today at 295.80. The value went to $157.68 per contract debit cost minus the cost when it was set up, 21.18. So you've got a gain of 136.50, or that's a gain of per option contract 100 shares, $13,650 per option spread. Okay, so look at the difference. So here's your risk when it was set up, was just doing this for $2,118. So you've got a return here at 644% return versus the covered stock with that downside put 99. So 6.5 times better return. So that's another really great structure that you can use for the different situations of the market. So these are kind of wanted to go through just kind of a broad kind of brush of what can be achieved, and if you want to look at it in more detail, my favorite trading vehicles for the different market conditions, I was only able to kind of scratch the surface here today. But like I said a little bit earlier here, if you want to really get into all this, join me this next Saturday for this live and recorded option strategy course, Surviving Market Turbulence. This is my option strategy playbook. So this course next week, and we'll go through these different spreads that I laid out here today, but in much greater detail. All right, so again, this will be next Saturday, live and recorded. If you can't make it, use that special link I gave you, powercycletrading.com/guide special. Let me give you that link again, and then use the guide 15, and that will give you the discount price. So I'll put that in again for anybody that missed it earlier. So put that in, and then put small cap guide, GUIDE, misspell that, GUI guide 15, small cap, and there you go. All right, and that'll give you the discount of 15% off. So today you'll get this course for 167 bucks if you do course package 1, option 1, but we'll go through this again. So there are 9 different enrollment bonuses if you want. And so this will start next Saturday, the 11th, 11 a.m. Eastern to 2 p.m. Eastern, or however long we need to get through part 1 of the course. And then we'll finish back up on Monday, the 13th, part 2, 4 to 5 p.m. Eastern, and then we'll do a dedicated Q&A Tuesday the next day. So for any questions that you might have on the course, so you'll that'll be kind of the setup there. So again, let's go through the details here, and then any questions. So here if you do course package 1, option 1, the workshop will be $1,600. Today you're going to get it for $167. So you're going to get that 50% off. Let me make sure. Let me see if there's questions. Any questions here? I just want to make sure I didn't miss anything. Everybody hear me okay? Like I said, I've got a little bit different platform I'm using here today, so I want to make sure I'm not missing something. Okay, so that's what you're going to get here. You'll get, as an extras, you'll get a 30-day trial membership to my trading club. We'll do that follow-up Q&A the next day on Tuesday. You'll get my option trading tutorial. So you're going to get, some additional extras here. Total course value with the bonuses, $2,100. If you use that promo code here today, it's $167, and that's using powercycletrading.com/guide special. And so then, if you want, though, just for an extra $30, if you want the additional the indicators that we're going to use in the course and the additional bonuses, just for that extra $30 here, it'll be $197 today. So with this, you'll get my cycle reversal indicator, you'll get my extreme range band indicator, you'll get the make my options intermediate course, beginner's course here. You'll get my Fibonacci price target mapping bonus course here. 30-day trial membership to the trading club. You can start this whenever you want. That access to the follow-up live and recorded Q&A, my option trading tutorial blueprint there, 197, and my 15 option strategy guide there. So you'll get all that, all those extras just for an additional 30 bucks. And that'll be 197. And then if you want it with the alert service package, where you'll get all 5 of my different trade alerts that I send out for the next 4 months, you can stop and start when you want. Plus, you get 4 months of the trading club. That's going to be course package 2, and you'll get everything in course package 1, whichever option you select here. So with this, you'll have access to any butterfly or condors that I might send out as an alert, or calendar diagonals that I send out, butterfly pin trades that I send out, or reversal trade setups, which are a lot of times credit spreads, or selective earnings trades during earnings season. So those are the different types of option strategies that you'll have on the alert service. Now, again, when I send these out, a lot of members just will do their own things. They might just buy calls or puts, or maybe they'll do a debit spread or something. But if you do this course package 2 and you want the option 1, that gives you everything in the extras in the course live and recorded. So this will be 507 using that promo code. If you want it with the indicators and all the bonuses, it's option 2, okay? And so today, just for that extra $30, 537, and there's a 2-pay if you want that. So you'll have the all 5 of my different alerts that I send out next 4 months. You'll have, could be counter diagonals, butterfly condors, pinning trades, credit spreads, selective earning trades. When I send them out, I'll send you out the option trade that I would recommend, but you might want to do something different. I do a video review of the trade after the close that day to show you what I was thinking, why it was done. Trades are listed and archived for you to go back and look at them. Then you have access to the trading club, which gives you weekly Q&As every week for the next 4 months. My video newsletter every day after the close for the next 4 months. Access to my virtual trading room during the week, next 4 months, and anything on my website, any courses or software, 50% off next 4 months on that. Okay, so that's kind of a run through on the alert service part of it. And then I use this service called Telegram. It's a free app and really fast, man. It goes out within seconds of when I hit the button to go out. So you'll get that, and that is what we're going to use there, Telegram. And I showed you the the unaudited year-to-date summary here. So we're currently running 83% win break-even rate, which I'm real happy with in this crazy market. So that's a look there. Year-to-date or 2025, 79% win break-even rate through that year. So a really good year on that. Looking at that reliability factor, and then since inception back in 2018 through Friday, running 79% win break-even rate on that. These are unaudited, but that's kind of what you can kind of expect that we'll continue having in the future. So that's a look there. And again, use this link here, powercycletrading.com/guide special. And then one more time, I'll put that in for you, GUIDE 15. Small cap, and then you'll get that discount, okay? So course package 1, option 1, just one more time, 167 today. And if you want it with the indicators and all the additional bonuses, just for an extra $30 today, 197. If you want it with my alerts for the next 4 months and trading club for the next 4 months, option 1, price 507 today, 2-pay if you'd like. And if you want it with alerts with all the bonuses and indicators for that extra 30 bucks, 537, and there's a 2-pay on that. So that's what you're looking for it. And then if you want to pay with credit card, remember, just up there just to show you. Here's just something from Dennis. He said, just finished the options master's course, loved it. Hedging on demand is a game changer. It allows one to enter trades with confidence. Already two of my probability trades, which were heading to my short strikes, were covered using converted to butterflies, which I exited at a higher profit than the original trade. I slept much better and the funds were reinvested. Compound interest is a little magic seldom mentioned with options. So that was really nice. And again, here's kind of an overview of what we'll start with next Saturday. We'll start out with part one. I'll let kind of go out through the foundation here of the options. So we'll go through the kind of importance of the different Greeks that you really need to understand. That'll be the kind of start, how that option pricing works. We'll go through that in a little bit more detail. That probability analysis, how to use standard deviation. We'll go through that in greater detail so you know exactly how to set up the expected move and standard deviations for your trade forecasting, and then how to use your deltas and option probabilities for that, and then how, when, and why to take advantage of your volatility and volatility skew, what that is and how that's used. We'll go through that. And then part two, or step two of the program, is the strategy guide. So this is where we're going to go through which option strategy to use. And this is going to be based on this kind of process to help select the best trade setup option strategy for the market conditions. So we're going to go through how do you determine, are we in an uptrend, downtrend, or sideways market? I'll go through the exact way I set that up to know specifically mechanically, are we up, down, sideways? Okay, so we'll go through that. We'll go through these chart patterns, which are very important for helping you, make the right option strategy for the different, option chart pattern that you're looking at. We'll go through that in great detail. And then what is the market condition? Okay, so we're going to quantify that, and I'll go through how I do that. The market uncertainty, are we high, low, extreme? And so this is going to then dictate what's the best option strategy to use if we're in a more extreme market condition, things like that. And then what's your trade duration for your profit that you're looking to achieve. And then step three, the process for selecting which strategy to use. So we'll go through what's going to be the best selling strategy to do based on what they are and how to use them. What would be the best buying strategy to use based on the same. And then using that, either the option butterfly, when would we use that, which is such an amazing advantage we get for very uncertain, high volatility markets. Also great for that time component selling and volatility and hedging. And these butterflies can, give us some big, huge potential profits on that very low risk. So we set one up here this week, on GLD for very low risk trade. So if I have time, I'll show you that one. So that's what we did earlier this week on a butterfly trade. And then part four, we'll go through the kind of go-to option strategies, when to use them, how to use them, and then when would you use them for hedging them more. So we'll go through in this part of the course the fun stuff, buying the options. Are we going to do calls or puts, or should we use a vertical debit spread using calls or puts? Which ones? Which one, butterfly along condors, when to use, and then also that counter diagonal spread. So we're going to cover the go-to strategies, when to use them, how to use them, what market condition to use them in, et cetera, for your hedging or income profits, things like that. And then I go through what I call my progression of hedging. This is the hedging part of the course, how, why, and when to hedge, what's the best way to hedge. So we'll go through what that is. Typically, that's going to be using the butterfly or condor. So we'll go through exactly how that works, and trading risk management. How do we adjust? So we're going to go through a number of different adjustments that we can do, from the calendar diagonals to condors, debit spreads, things like that. So a lot of adjustment stuff that I'll talk about and go through. And this really comes down to, understanding that how do you match your vertical spreads to do these hedging adjustments. All right, so that's kind of a basic overview. So it's a really detailed, very thorough course. And, a lot of times what we're striving to is adjust to a free trade or something like that. So I'll step you through. So the guide, there's a number of steps. It's like playing chess. We're looking at 2 to 3 steps ahead, and we have an ultimate goal for a lot of these trades to see if we can adjust it to a risk-free trade. All right. So this course will kind of show you that step-by-step progression that I look for and how to do that. Then there you'll get my resources, what is assignment risk, expiration, auto exercise, and then more on standard deviation, and a good trading library you can go through looking at past trades to help you understand how they work. So very detailed. And then as far as the bonuses, let's go through here what you'll get as additional bonuses. If you do option 2, you're going to get my cycle reversal indicator. So this is an indicator that has an upper and lower steady to it. And this is what I use for cycle reversals, up or down. It's a what I call my alert to a potential change in cycle. And this gives you the indicator gives you this alert to this cycle trend change up or down, and will give you an arrow, colored arrow up or down for the reversal. Anyway, so that's what you're going to get. You'll get this if you do course package or option 2. I've got this available for Thinkorswim TradeStation trading views. You can have one or all. And so that comes with the course, cycle reversal indicator. And here's just an example. Here was Amazon. This is such a great indicator. You can see we had a cycle reversal here, and then it started trading back up. We had a cycle reversal here. Anyway, that's kind of a highlight there to kind of show you exactly what that looks like. There's an upper and lower steady with this indicator. Then you're also going to get my bonus 2 will be my extreme range band indicator. So this is one that I like to use a lot when we get into extreme stretch markets, either to the upside or downside. So when price is too extended from the mean, which is a typical, typically a moving average, 20 period, something like that, this is gives an alert signal for either buying or selling exhaustion. So that becomes kind of the first signal that a security is starting to reverse. So very, very accurate for signaling in advance potential changes in cycles that you can use for your swing trades or longer term market trend trades. And so these bands are measured by average true range, and that's how we use them. So extreme range band, I've got this for Thinkorswim TradeStation eSignal Ninja Trader, so you'll get that. So you can see here the extreme range bands with the cycle reversal indicator, really great combination of tools. So this was like on QQQ, the daily time frame. You see it at a cycle reversal here, and it was that up here kind of stretched to that the extreme range band 3, pulls back. Here was another one starting to set up here, really stretched out. Anyway, you'll get that as a add on your bonus indicator there. And then bonus 3, you'll get if you do option 2 will be my make money with options today. So this is an option kind of intermediate course that really gets you started with your options if you're a little bit rusty on things, but very comprehensive, easy to understand option training. This goes through the benefits of options versus stocks. Need to know basics about the options, mastering puts and calls, how option expiration works, and also covers 3 really nice option strategies: the covered call, plus the covered call with the protective put strategy, and the vertical debit spread. So this is an add-on bonus course for you if you do course package option 2. And then 4 is if you do package option 2 is my Fibonacci price target mapping course. So fantastic course, 3+ hour live and recorded course with a trade manual of the course. So this is what I use to set up profit targets up or down or defense targets. And it's basically what I call Fibonacci target mapping, because it not only uses Fibonacci, but it also using moving averages, price action support resistance, standard deviation, unusual option activity. So it goes through this course, explains how that's done, and that's how we set our prices with this price target mapping. So we'll be using this in the course as well. So you get that as a bonus. And then basically everybody here, if you do course package 1, you'll get a 30-day trial membership to my trading club. So this gives you access to my virtual trading room during the week, Wednesday through Friday, 9:30 to 10:30 Eastern. And then you have access to my daily video newsletter every day after the close. Live and recorded Q&As every week during the week. You'll have access to that for the next 30 days. If you want to renew, then it's $97 a month. We have other different packages. You can just renew and stay on, hopefully. access to the Trader's Educational Vault, and you'll get 50% discounts on any course trading software on my website. You'll get a members code to give you a discount there. And I always like to point out, one of my old members here, Jay, said, reading books is fine, but seeing the actual option trade setups makes a huge difference. And thank you much. And Jay is still a member. Gosh, she's been with me for quite a while. And then bonus 6, we'll do that follow-up Q&A. The next day, we're going to dedicate Tuesday to that. This will be live and recorded to go back through the course, any questions you have on that. Plus, remember, you'll have that trial membership, or if you do the alert service, you'll have the next 4 months. And then you'll get my, everybody get my option trading tutorial. So this is a 60-page option guide with videos. And this thing is more focused and dedicated to the option Greeks, gamma, delta, theta, those things, option pricing, market maker secret, standard deviation, option delta, and probability. So more option education there for you with that tutorial. Really nice, very clear. And then one last thing, you'll get my top 15 option strategy guidebook. This goes through other different options structures, so back ratio spread or strangles or straddles, things like that. So just gives you a complete library for your option trading. And then one last thing, you'll get my handout for the option Greeks you can print, put out on your desktop. So that's pretty much wraps up everything you'll get. And then again, let me see if there's any questions here. Feel free to ask any additional questions. Put in that link there, powercycletrading.com/guide15, and then the promo code GUIDE15. So that'll be the promo code link you'll do there. And then the alert service, here's one of my members, Waleed, who's in Kuwait. Hopefully he's doing okay. I don't know. I haven't heard from him in a while, but said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing I would like people on this webinar to know is that when I get a trade from Larry, I do it blindly, as time has shown me that this man is dead accurate in his trade recommendations. All right, so that's really nice feedback from Waleed. And Dan says, you're very diligent and totally thorough with your analysis. That is the foundation of the success of the alerts. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. Please feel free to share this with your participants if you wish. All right. So again, if you do want to add the alert service, which I highly recommend, you'll get 4 months of all the different 5 alerts that I send out, 4 months of the trading club. So for today, if you do it with option 1, which is the course and all the extras, 507. If you want the add-ons, the indicator, all the bonuses, just for extra 30 bucks, 537. And we kind of touched on everything you're going to get there. And then when I do send out a trade, like I said, a lot of members they'll do their own thing. Maybe they'll buy calls or puts, but I will always give you a suggested option trade setup that I think is the best for the market condition, the cycle that we're in, things like that, things that you're going to learn in the course next Saturday, okay? What trade to use, what option to trade to use based on the market, etc. I'll give you the entry price. I'll give you price targets when these are sent out. And these targets are all based on that Fibonacci price target mapping, which you get as an additional bonus here. I tell you exactly what option series to use, your stop loss levels, and then these are all monitored throughout the day, every day during the week. And I constantly send out text and tell you what to do or not to do, or I'll give you adjustments if needed to adjust the trade for risk. Okay, so those are constantly updated. Then I do a video review of the trade after it's done that day to tell you why, kind of a little bit more detail why it was done. And then I do that video newsletter every day after the close to kind of give you my view of the market, what trades we're looking at, what trades we've done. And then we have that weekly Q&A every week during the week for the next 4 months. You'll have that access to the virtual trading room for the next 4 months. And that's going to be Wednesday through Friday, 9:30 to 10:30 Eastern. And then discounts of 50% off on everything on my website, courses, software, things like that, and educational material that's free. So here's just a brief overview of the calendar and diagonal part of the alert service. And so This is one where we do a lot of these. So I started this part of the service back in June of 2019, and through Friday, we're running a 78% win break-even rate. We've had a 410 trades closed out, 290 winners, 31 break-even, 89 losers. So really nice high winning break-even rate there, unaudited. But these have been great trades. We've had a lot of huge winners on these. So here's one that we had just recently. This was on Slumberjay, just to go through a few more of these. And so this was set up on the 24th. Slumberjay was trading at 50.40. So you can see here it says new Slumberjay long trade at 50.40. Daily cycle low retracement reversal and breaking back above the 50 simple moving average. Daily positive momentum, cycle 1 and 2. These are my indicators. Upside momentum cross. Here's target 1, 51.5, 52.5. Know your risk and buy this diagonal, calendar diagonal here. So it was going out by the 10 April, shorting the 26 March, 50-40 call calendar diagonal at around 205. And then on the 27th, we did an adjustment here. Update, now it's trading at 52.84. If long the spread, make sure you lock in some profit, currently up $150 per spread. We'll look to adjust. And then did send out the adjustment here on that day. Now it's trading at 52.89. If long this call and short the 54, make sure you locked in some profit, adjust currently up around 151. So here was the adjustment since buy to close. This was going through the adjustment. I'll show you here in a minute so you don't have to read through this. And then here it was profit update, Slumberjay. Now it's trading at 53.42. If you are long the adjusted 10 April 50 call, short the 2 April 56 call, currently up around $200, fast moving market, things like that. So that's kind of what you can expect on these type of alert updates. And so here was the Slumberjay trade setup. This was on the 24th right here. So it was a beautiful trade setup, cycle reversal, cycle momentum 1 and 2 are going positive. We had price trigger alert right there, cross above that key moving average, and just really shot up. And we ended up getting out right here. This was coming up to that 1272 extension Fibonacci. And so took the profit here, which was the right thing to do because the next day or so, this thing started falling apart. So here's what that looked like as the pure calendar diagonal that we set up. Originally on that 10 April 50 call, short the 27 March 54, $4 wide, $205 per spread. On the 27th, that had blown to 356. So we were up $151 per one spread, right? 74% return on that Slumberjay trade there. So that was a look there. And then on the 27th, a little bit later in the day, now we're up $201 per spread, or 112% return. All right, so that was actually after had an adjustment on that trade. We went from the 27 March 54 strike, we closed that out, and we went to the 2 April 56 strike. So that was the adjustment there. We increased the profit on that. All right, so that was a look there. Here was another one that we did not long ago. This was on W Day, and I'll just kind of go through these kind of quickly. But here was another alert trade that was sent out. This was on the 11th. The W Day was trading 138. And then we got out of this pretty fast on the 16th. These trades are been moving pretty quick in and out because of the market conditions. So that's what I'm doing, navigating these trades for you with the alert service. So you don't have to do it. I know what, a lot of, I've been doing this for a long time, so I kind of have a better feel for it probably than maybe a lot of you might have, but that may not be the case. But anyway, so this was a put calendar diagonal. Okay, so this was for a short trade to the downside. So I said new W Day aggressive short based on the 4-hour time frame. It was trading when we set it up around 138, and it was a daily cycle high retracement reversal, 4-hour negative momentum, etc. Here's your price target 1 to the downside, 132, target 2, 128. The trade setup was buy diagonal W Day, the 27 March, short the 26 March. It's just a really tight spread, 138, 128 at around 455. All right, so then on the 16th, it was now trading at 134.20. So if long the 27 March 138, 20 March 128. I'm sorry, this was long the 27 March right here, short the 20 March right there. Okay. So then I said, make sure that you locked in some profit, hold break even stop on the balance. It was up 122 bucks. And so this thing then started turning around. So we did get out based on, we had profit take and then got out on our break even stop. So here was the short trade set up. You can see it right here on the 11th, the trade when we set it up right here. You can see it's got that reversal arrow right there. This thing is starting to break down. And so set this up doing that counter, put counter diagonal, and ended up trade getting out right there. See it pretty much flattened out. Was very volatile, but you know, got a nice little profit on that. And then W day, you can see where it was. It was up. It went on the date here, the 16th. This was now trading the spread on the 16th was now, it was trading at 134.12 from 138. So that spread blew from 455. Now it was at 595, up under 40 bucks, 31% return. Okay. So, you know, nothing to sneeze at. Here was that Palo Alto trade. Now this was a 31% return, right? But look at this trade. This was the Palo Alto I showed you earlier. This was a 1,266% return. So, you know, some are chipping away, singles, singles, singles. Some are home runs. This was a home run. So you never know what you're going to get. You know, like a, you know, box of chocolates, right? Now here's another one that was a really nice trending trade we did on Chevron. This was a counter diagonal setup. It's traded at 157.25. We did a number of adjustments here and then out on the 23rd of January. And I'll just kind of, I won't go through the details here, but here was the what it looked like when we got into the trade was trade at 157.25. We had our cycle reversal, momentum up, got in right here, beautiful trend up, and out right there. On the 23rd, it was trading at 167.80. This was on Chevron calendar diagonal, which we did an adjustment as well on this one. And this is what you're going to learn in the course as well, these adjustments, how we do these. And so now set this up on the 8th, and it was 157, had a profit take and adjustment here on the 9th. So the calendar diagonal, 157, 165. Now this was up, spread blew to 470. So we're up $226 on this pure spread play, 92%. But then we adjusted the trade into, I believe this one we adjusted into a free trade. So we did this into that call condor structure. And so we rolled the whole spread, did some movements on the adjustments of the long side. So now we adjusted this into the 23 Jan 160, 167.5 call debit spread. We adjusted into, and then we sold against that the 172.5, 180 credit spread, and we reduced our risk to zero. Actually, we had a 2-cent or $2 credit. So potential, this $7.5 wide spread plus the credit that we adjusted down to, potential to make $752 on zero risk. And this one went out home run perfect. So it went out right there. This is up $733 per spread on zero risk there. So that was, you know, a beautiful trade there. And then here's just an example of one that we did. This is the butterfly part of the alert service. So this is from starting out back also in 2019 through Friday. We've had 247 trades closed out, 175 winners, 22 break even, 50 losers, 80% win break even rate. So these are butterflies are the lowest risk trades and the potential highest return type trades. Again, these are unaudited, but just to show you a little, you know, an example of what you can receive here. Now, this is one that we did. Again, this was actually starting out as a call calendar diagonal on Apple, but we adjusted this into the call condor. And so started this Apple trade along the second. Now, Apple looks really good now, too, to throw that out. We're going to look at that on Monday, maybe go along, we'll see where it is. But this is one that we set up on Apple. It's trading at 263.40. Did adjustments on the 3rd and the 5th, and then profit on the 11th. And so we went from that calendar diagonal to a long call condor. So here's, the alerts that were sent out, all that. And so we started out with the trade right here. Okay, so you can just see the chart pattern here. This is what I call cycle low reversal, retracement reversal of a key moving average. We had the reversal, momentum right here. We got in right here, price trigger when it was breaking here, adjustment here, and out there. All right, so this was originally started with that call counter diagonal, and then we adjusted it to the call condor. So we ended up in the 13 Feb series that we had the long dated in initially. So now we were long the 167F, 267F 280 called debit spread side. We added to that, bringing in premium to 187 300. So we had this condor, and we adjusted our price down to $75 debit cost. Spread width, look at this, it's a $1,250 wide spread, so $12.50 wide spread on each side. Our cost now is reduced to 75, potential to make 1,175 that goes out here, up 1,566% return potential on that. And I think, yeah, we got pretty close to that on this one. So again, this is what you are going to be learning about next Saturday. So I hope you take advantage of this. And so then you can see on the 11th, now it's trading at 278.99, and the spread adjusted went from 75 to 994, so up 919 per one spread, 1,225% return. So that was the Apple trade, really neat trade on that. And then here's just one more lotto trade that we did. This was a one alert trade on GLD, the gold ETF. And so this was one that we did for pin trade again. So this was, back in December, but new long GLD long binary call butterfly. It was traded at 387.90. We were looking for a move to potential pin at 400. I won't go through all that detail, but then we pretty much got close to it. So then on the 19th of December, now it was trading at 397.5. And I sent out the alert. I said, make sure to take some profit, all long balance prior to the close today, max profit, a pin at 400. It was currently up $135 per spread. It was up 540% return. And then here it was at the end of the day, going out close to the end of the day, it was up 399.80. So this was up, at that time, it was up $375. This was up 1,224% return. So this was another lotto trade here, got in right there on GLD and pretty much closely pinned right there at the 400 strike. So here's that beautiful butterfly, 396, 400, 400, 404, $4 wide spread. We had the price here that we got in, 25-cent debit, potential to make 375, 1,500% return. And this thing went out pretty close, went out right there at 399.74, up $306 per spread, 1,224% return. So I hope that is some interesting stuff to everybody. And if you'd like to learn how to do these kind of debit spreads, condors, butterflies, calendar diagonals, and the adjustments, then make sure for just 167 bucks, it'll be the best 167 you ever spend right there. You'll make this back so fast. Or if you want to do it with all the bonuses together, just for an extra $30, 197, man, you can't go wrong on this at all. So just right there, sign up today and just use that special code, powercycletrading.com/guide special into your browser, or copy or link on it. And then if you want the course plus all the bonuses here, just for an extra $30, you got it, 197. And you have everything in this course live recorded, yours forever. Now, if you want the alerts added to it, which I would highly recommend, then you've got your alerts for 4 months, Trading Club for 4 months. You can stop and start whenever you want. And you've got your pricing here, or if you do course package 2, this is course package 2, option 1, with the alerts, 507. There's 2Pay if you want it with the indicators and the bonuses just for an extra 30 bucks, 537 right there. All right, so that's pretty much concludes everything, and I'm so happy that everybody's here. I know it's a Easter weekend, but I want to say thank you so much for everybody being here, and I'm looking forward to seeing a bunch of you next Saturday, and then a bunch of you this week in the trading room and things like that. So any last questions, let me know. If not, we will call it a day. I don't see anything else going on here. Let's see, any questions? All right. All right, thanks, Barbara. Thanks, John. All right, I think that's everything. Here's the link one more time for you. For anybody that missed it, it should be still in there. And then put guide 15. And you're good to go. Thanks again, everybody. Have a great rest of your day and weekend. And good luck next week trading. Ciao.